It cut its policy rate, or call it the key lending rate to commercial banks, by some 350 basis points to 21.5%. Now, if you move back over the past 3 months, that brings about more than 300 or more than 600 basis point cut in the rate that they lend to commercial banks. What is the Bank of Ghana trying to achieve with these steep cut in just 3 to 4 months? Have they factored inflation, the threat to inflation? Have they factored the expected increase in the tariffs and how that would impact the economy? Could they end up coming back to reverse that action? What would this action actually mean to you if you are currently servicing a loan or you intend to take one? What does this also signal about the broader economy? And can this do the trick in terms of firmly stabilizing the Ghana cedi with respect to the recent pressures? Well, on PM Express Business Edition, we're doing the policy rate cuts, the cedi, the economy, and also understanding this whole policy rate cut decision by the Bank of Ghana. And I'm indeed grateful to have the Director of Research at the Bank of Ghana, Dr. Philip Abrodote. Doc, thank you so much for your time and joining us on PM Extra Business Edition to actually appreciate what went into these policy rate cuts and all the rest. But help me out in reading the minds of the committee members when the governor said that by a majority decision, you've cut the policy rate by 350 basis points. What went into that?
Well, thank you very much. I think the things that go into arriving at a decision as to where to put the key policy rate of a central bank involves many factors. The committee, in arriving at this decision, discusses issues about the real sector of the economy.
Where the real sector, help us for those of our viewers who might not be that connected or appreciate the Economist 101.
So when we talk about real sector of the economy, we're talking about how businesses are faring. We're talking about how consumers are also faring, and whether consumers are feeling the pinch of economic adjustments that is taking place, whether spending in the economy is at a level that is consistent with what the fiscal authorities, for instance, might expect, because the more we spend, the more the fiscal authorities are also able to extract revenues for development purposes. So when we talk about the real sector, we are looking at a variety of indicators. The Bank of Ghana has developed its own way of gauging how the real sector of the economy is performing, and periodically the Ghana Statistical Service also comes out with figures on how the overall economy is performing. So when we talk about the real sector of the economy, it's about what me and you are doing in the economy. It's about what businesses are doing in the economy. And we try to gauge the tempo of all these activities in the economy. Imports, exports, all these things fit under the real sector of the economy. So we try to gauge activities in the real sector of the economy. We try to look at what is going on with respect to prices. Inflation, you call it inflation, and then we try to even look at what the forecast of all these indicators look like, especially for inflation, and are we getting close to our target? And having done this, we also look at even the banking sector. Are they positioned in a way to help support growth in the economy? Because the main job of banks in the country is to support growth. Okay, so are banks well positioned to deliver growth in the economy? And having done that, we then look at the risks surrounding all these things. And then we try to put all these things together in a framework to decide as to whether going forward we should be confident about ourselves, and whether going forward we think that the risks are very minimal, and whether we can then reposition our key policy rate to deliver continued growth in a sustainable manner. I think the key word is sustainable manner in the economy.
I mean, Doc, in this opening round of engagement, I want to do some 101s here and then pull the viewers along. I mean, I know your work, and the governor said it yesterday at the NPC, is about data. And data influences everything that you do. How does the makeup, the psychology, the lenience, I mean, if we're in the US, you talk about whether the person is center, right, left, of these members who vote impact the decision of the policy rate cut? Because if, for instance, I am for a pro free market, and more credit to private sector, irrespective of the challenges of the economy, that could influence my vote. How does the vote or the makeup of these members, you are part of the Monetary Policy Committee, impact that final vote? When the governor said that by a majority decision, we are voting to cut by this 350 basis points.
But before I answer that question, I think one thing was clear at this meeting. It was unanimous.
Oh, okay. So it wasn't a majority decision.
Yes, it was unanimous, and majority voted for a 350 basis cut in the policy rate. Unanimous because everybody, after seeing the data, was of the view that we needed to give something back to the economy in terms of a policy rate cut. But back to your question, I think your question, basically what you are trying to say is whether on the committee there are people on the committee who are I call these people inflation nutters. So these are people who hate inflation to the core, that they just keep looking at inflation to inform their decisions. And there are those on the other side who will do everything they can to ensure that real sector activity go in the direction that they want. So these guys love the real sector so much, and then these guys also don't want inflation at all. And therefore, those who don't want inflation at all will always want to, keep the policy rate tight and high to constrain aggregate demand in the economy to push inflation down.
So I mean, the psyche or the belief didn't sway the vote any way that some would say that doesn't reflect development on the market. You don't think so, Doc?
No.
I mean, again, let's come back to the policy rate cuts.
Yes.
The Bank of Ghana is working with a policy of inflation targeting and trying to check literally the amount of money in circulation. We are now hovering around 11.5%.
Okay.
The Bank of Ghana's target, I get it right, was about 12% end of year. I stand to be corrected. Now, some are saying that there are some threats to inflation. You have a situation where one thing is clear, that we will have a significant hike in the tariffs. The tariffs might not be the 200 or 400, but it will go up a little bit. There are fuel price hikes that could be taking real impact on the economy the next 2 weeks and all the rest. There are some who are worried that if the Bank of Ghana is indeed for this inflation targeting of trying to check the general price levels with these monetary tools, a marginal cut would have been the prudent thing to do. Watch the market and then react again, than to go this 350 basis point cut. If you track back the past 3 or 4 months, you've done more than 600. That is quite a steep one.
Well, but so you're forgetting also the fact that our interest rates, when you look at real interest rates in Ghana, and you juxtapose that with other economies in the world, our real interest rates have been very, very high. You have an inflation rate of 11, and then you have a policy rate of 25. If you look at that difference, it's a real rate of 14 is the highest in the world, the highest real interest rate you can have in the world. And you know what that real interest rate does in the economy? It kills growth. It kills growth. Yes, it kills growth. So I think we've gotten to a point where, given the state of the macro fundamentals, given where we are in terms of reserves and the ability to use the reserves that we have to smoothing fluctuations in the exchange rate, so as not to allow these exchange rates movements feed into prices. We've gotten to a point where we feel that on the macro level, we are okay to help us achieve our inflation objective. So, given the fact that real interest rates are so high, given the fact that if you look at our growth numbers into detail, it only makes sense to give back to the economy some of these high real interest rates to allow them to deliver on growth. And mind you, the fact that we are an inflation targeting central bank does not mean we don't care about growth. We care a lot about growth because in our decision making, growth plays a very key role. So it depends on the weight you put on growth and on the weight that you put on
Doc,
inflation.
you raised the argument about the negative impact of real interest rate being high on growth. Again, I stand to be corrected.
Yeah.
Q1 and Q2 numbers in terms of growth, some are saying they are great, and we're still having a very high real interest rate. So some are saying that maybe the committee's fear, the Bank of Ghana's fear about it impacting on growth is more of much ado about nothing.
I want more growth, George. I want more growth that will generate jobs in the economy. I want more growth that will keep people out of the streets. I mean, you drive around and you see people around the street. We need to get all those people out of the street. Go to other communities and you see people. People need to work, George. I'm being careful. Yeah, people need to work. But what you also need to ask yourself, George, is the growth numbers that we are seeing. Where is it coming from? Okay, where is the growth coming from? Is it metal driven? Commodities driven is what you are talking about, and is it generating the jobs that we want? So we want that kind of growth that is organic, that kind of growth where an individual can leverage on bank borrowing to build an empire, to absorb labor and make everybody happy in the economy. I want more growth. If you adjust the growth that we have now for the metals that you are talking about, you realize that we need more.
But again,
you realize that we need more.
The concern about inflation, and I don't know what the committee members saw, but there are some analysts outside who are worried about the impact of what you've done on inflation. It eases or bring about more credit to the system. You're looking at the utility tariffs.
Did you say it brings up more credit
because
to the system?
It is reducing the interest rates.
Yeah.
Therefore, it will lend as well.
But George, is that not what we want?
But again, some are saying that it should match the economic activities in the country. So there are some who are worried that even though you want to stimulate growth, maybe inflation is not in check. Help me again appreciate what data was presented in your meeting that should give us some comfort in terms of inflation outlook for those who are saying that your 350 basis point is too high.
So the question is, Let me rephrase the question for you. The question is whether the committee in its deliberation did see that the current inflation level of 11.5
will still continue going down.
Will still continue.
Despite fuel prices going up, despite the tariffs going up.
Yeah, we've had all these things.
Transport fares going up and all those things.
Yeah.
Were all those extrapolations or these scenarios factored in your modeling when it comes to the next 2 or 3 months before you took this decision?
Yes, all these things were factored in the modeling. Let me touch on the utility issue. In looking forward, we had factored in the baseline scenario, we had factored in some utility, transport, and petroleum price hikes. And in the base scenario, having factored in all these elements, inflation still stayed below 10% at the end of the year. Looking ahead, you touched it in your opening remarks about the fact that there are all these utility tariffs coming on. We hear 170%, we hear 100%, we hear 250%, and so on and so forth. The question is whether these things are going to be fostered on the economy next year. All these things are next year. The talk out there is that these things are going to be done in the context of the medium year. They call it what, the medium year tariff, MITO or something, medium year tariff order. They call it a medium year tariff order. I think it happens once every 5 years.
And one is due this October, first week in October.
In fact, I don't think anything will be done this year. I think all these things are setting the stage for next year. We haven't factored these into the projections as yet because there is still uncertainty. We don't know what numbers are going to be settled on in the final analysis. And when we get there, at that point, we will see what all these things mean for the forecast. But we also need to take cognizance of the fact that the economy is also in a very good spot. And therefore, despite the fact that these things could be coming on board next year, on the other side, the macro fundamentals look good. We see a fiscal posture that is right. We see the central bank stepping up on all its liquidity activities to ensure that that demand component that fuels inflation is kept at bay. We don't see any central bank financing of the budget to be injecting high-powered liquidity into the system. Reserves are adequate now. You recall at the tail end of the crisis that is getting into 2023, reserves were at 2 weeks of import cover. We've progressively built reserves since 2023 all throughout, and we had about 4.5 months of import cover of reserves. I mean, what that means is that today, if there's a crisis in the economy and everything is at a standstill, we can run this economy for 5 months. Based on it, we can run this economy for 5 months and ensure that the imports come in. All the essential come in to deliver.
It appears the Bank of Ghana
on economic activity.
Confidence based on whatever data that you are seeing about the inflation outlook. And you're talking about 10%. I mean, there are some within some economists, some government officials that are even projecting that we could even hit the single-digit target even before the end of this year. Does the bank support that those projections and extrapolations being put out, since you talk about 10%?
Yes. So at the beginning of the year, when we did our projections going forward, the expectation was for the bank to get within that single-digit mode in the first quarter of 2026. But we've seen a rapid disinflation. The disinflation has come in faster than what the models were were predicting. And where we sit today, that forecast of inflation getting to within target in the first quarter of 2026 has been pushed forward to the last quarter, to the last quarter of 2025. So we are getting there in the last quarter of 2025, based on the numbers, barring any significant shock in the economy. I think we should be there in the last quarter, or even pretty faster than that.
It appears that played a major role in your 3.5% cut in the policy rate.
Well, it's one of the factors. It's one of the factors. It did, yes.
It means that you're quite optimistic that we wouldn't have any headwinds or turbulence that could throw things out of gear.
So we also did look at the external side. And the external side is also a key source of shock to the Ghanaian economy. Historically, if you look at our data and the way our economic situation evolves, the two key main sources of shocks are those that are transmitted from outside our borders, external sector shocks. We have commodity price shocks, and then fiscal shocks. Three key shocks that normally disturb us. We can discuss each of these shocks. We can discuss fiscal. We think fiscal policy is being run well as we said. So that surprise from the fiscal side to introduce uncertainty into the whole economic discourse, I have discounted it for now. On the global side, the commodities are in our favor now. Gold is on the upsurge, crude oil is down, and then cocoa is also up. These things are favoring us, but of course there are also risks there because those things can turn around within a short period of time. And then the other geopolitical shocks that can also kick in. Am I worried about those geopolitical shocks? For now, I'm not too worried about those geopolitical shocks. And therefore, in my mind, I think we are in a pretty good spot now.
I still want to get to in the mind of these Monetary Policy Committee members. Treasury bills rate was around, I stand to be corrected, 10-11% there. You're looking at policy rate 25%. I don't know whether I'm using the right expression. Did the committee feel under pressure from the fiscal side to respond by also dropping your rate significantly down so that when government goes to the T-bill market, they could get some oversubscription there?
No, I don't think the committee is pressured. And if the committee was pressured to do something like that,
it could have way.
It could have moved. It could have moved the rates down at a go, boom, and we are done. But the committee is looking at the data in a gradualist approach, in a gradualist manner, and deciding as we move along and as the data comes in. I mean, if you look at what we've done, we did 300 at the last policy meeting. We've done 350 now. So far, we've done 6. We'll be looking at the last set of data in November to see whether that data set will materially affect our view of the economy looking ahead, say 6 months. And given what we will decide at that committee at that time, another decision could be taken at that point in time.
So, Doug, I get from you that there wasn't any subtle pressure on the Bank of Ghana to respond to the T-bill rates cut so that at least that real interest rate gap can be closed, that when government goes onto the market, they could see these investors come to buy their bills instead of going for your Omo bills. There wasn't any subtle pressure.
The gap now is 10 vis-a-vis what? Where are we now?
Yeah.
We came down 3.5.
21.5%.
Yes. So if you look at that gap between the T-bill rates and where we are, the gap still exists. Nobody is being pressured. No subtle pressure.
Official saying that we are going onto the market, we are not getting our bills, we are not getting what we look for. Bank of Ghana, do something about your policy rate.
So let me explain. When we talk about the independence of the central bank, it comes in two forms. The first form is whether the central bank is free enough to use the tools that it has to deliver on its objective. Okay? Nobody tells the Monetary Policy Committee what to do as far as interest rates is concerned. So let's rule the subtle pressure thing, underlying pressure,
body pressure, signaling pressure.
No,
this is PM Express Business Edition, engaging the head of research at the Bank of Ghana, Dr. Philip Abrodoetu, as you look at the policy rate cut, the cedi, and the economy. Appreciating and understanding the policy rate decision of the Monetary Policy Committee of the Bank of Ghana, getting some deeper understanding on PM Express Business Edition. We'll be right back after this break. Welcome back to PM Express Business Edition as we talk about the policy rate cut by the Monetary Policy Committee of the Bank of Ghana, the Ghana cedi, and the broader economy, helping us appreciate the monetary policy rate decision cutting the rate by some 350 basis points by the Bank of Ghana yesterday to this new level, and how would that actually impact on that loan that you're currently servicing with that commercial bank, or if you indeed intend to take one. What signals are the Bank of Ghana telling us about the outlook of the economy? Doc, again, the cedi has been under some pressure. Some may call it seasonal, some may call it some excessive demand, some may call it a response to the recent sharp appreciation. Did you factor the current pressure on the Ghana cedi in taking the decision? Because the fear here again is that if you cut the rate too steep, you could end up exacerbating the current pressure on the Ghana cedi. Are we wrong when we say that? What is the Bank of Ghana seeing? They are not in tune with current happenings on the market.
So your question is, are we worried about
that this cut could actually worsen the current woes or pressure of the Ghana cedi?
This is how I tend to look at it. If you look at the data from the beginning of the year to date, the cedi,
21%.
The cedi has gained 21%.
From 40%, actually.
Yeah,
over 40%, yeah.
Over the dollar.
Yeah.
The question is, your question is that 21% worrying?
Yeah, because it's been sliding down. It's not been going up. And again, if you look at even just from July or to August to September, the cedi has lost almost 8% in value. Anybody who's looking at the third quarter numbers should be worried.
So if you look at the data again, and here is what you see, what we call a front loading of the seasonal pressures. Let's call it that way. Front loading of the seasonal pressures. I say front loading of the seasonal pressures because there is a little bit of seasonality in what we saw in July. July is just a month after June, mid-year. Normally, these people or these importers who are getting ready for their Christmas festivities begin to take position at the end of September, October for their orders to come in December. What we've seen this year, the data from the banks suggests that a lot more of those people have already set in motion their orders for the Christmas festivities. So they've shifted that seasonal demand from September, and they shifted it forward to July. Why did they do that? They did that because the rate was favorable, and it only makes sense for them to take advantage of the drop in the exchange rate to seize on the current conditions to bring in the imports quicker and faster. So this is what we've seen in the data. The question is, will that seasonal demand that we normally see around September, October appear and put pressure on the cedi? My thinking is that we might not necessarily see that pressure around that time. So the appreciation of the currency has forced a change in behavior, and people are importing a little bit earlier, and that is how come we saw all this pressure in the month of July. My expectation is that things will cool down as we move towards October, November, and of course that period will also coincide with some cocoa flows as well, and therefore yes, and therefore I think things should be a little bit quieter as we move towards the end of the year. So yes, we did look at all these indicators, and our gauge was that the exchange rate will tone down a little bit as we move. And when you factor all these things into the forecast, into the frameworks that we have, then the outlook is not looking bad at all.
Doc, you talked about the seasonality of the Ghana cedi coming under pressure. We've always had this challenge. Why is the Bank of Ghana not getting over this challenge, since this is always not a surprise? We know that it will happen between August, September, October. We have more demand coming in. It's always been a perennial thing, and sometimes even Q1 of every year when people are trying to import as well. Why is the Bank of Ghana not getting around this challenge? If we always know that it's like living in a compound house with a leaking roof. You know that anytime we get to the rainy season, it will leak. But then we wait for it to leak. We get bowls, saucepans to put in the room to take this leaking. What is the Bank of Ghana doing about this seasonality that we always have to then move in to deal with it?
Well, so George, it all boils down to reserves. Ability for the economy to generate enough income from abroad to support all these activities. So it's a structural thing in the economy. We need to get cheap credit, okay, to be able to produce and export and get more income. And then all these things will be racked up at the central bank to help support the currency as we move along. So there are structural factors at play. And some of these, how to resolve these structural factors go beyond, it goes beyond the central bank. Yes, it goes beyond the central bank. We need to relook at the whole economic paradigm and then make sure that we are doing things in a way that will support exports. Exports is the main thing that we need in the economy. Should it be exports of metals, as you suggested? It's not only export of metals. We need to go beyond and export. We need to produce, export, get income. All these things feed through to the central bank. The central bank then is in a better position to deal with excessive volatilities in the exchange rate.
I don't know whether the dynamics have changed, but there's always an argument or school of thought that in every round of depreciation, there is an element of speculatory activity. There's an element of the fear of unknown. People also don't trust the current system about what will happen next. And that always play into that round of depreciation. One of the critical things that people would bet on the cedi's outlook is your state of reserves. I look at your 10.7 now, very strong reserves.
Yeah.
Very strong economic data, external position as well. Why is the market not responding to this data? Do you think that we've gotten to the level where people still do not trust the Bank of Ghana's data? Or why?
What are you expecting?
I'm expecting that because of strong economic data, strong reserves, that should impact on the city's performance.
Has the city not performed?
We've
George?
seen almost 8%.
I mean, George,
it has performed. I mean, 1% appreciation is quite strong. If you compare that to our peers in the market, that is a strong appreciation. But when I look at the Q3 numbers, I am worried about what is going to happen next month. I'm worried about what will happen in the last quarter of this year. When you're seeing an 8% depreciation within a month, that is why I'm just asking these questions.
Well, so we started off the year with reserves of around 8.9 or something, 8.98 billion US dollars. And we are somewhere around 10.7, 10.8. We've been able to add close to $2 billion in reserves. The corresponding effect is what you're seeing, for instance, in the exchange rate. And you see that correspondingly with that accumulation of reserves of about 2 billion, the city has also gained strength correspondingly. And we think that irrespective of what is happening now, by the end of the year, the city will still record an appreciable gain against the US dollar. I think what we need to do is to continue to do what we are doing, is to continue to look for ways to build our reserves in a very sustainable manner, to put us in a position where we can always deal with these eventualities as and when they occur in the economy, and to support economic activity.
Some have linked your previous market interventions as a critical example in supporting that sharp appreciation that we saw. And some who are saying that it is because the Bank of Ghana is now not regularly on the market, you're not intervening. That is why we are seeing this correction taking place. How do you respond to those concerns that if the Bank of Ghana had been that active on the market, we would have still seen the city being very strong within the 10 range or the 11 range?
Well, we are still continuing to support economic activity. We are still dealing with the banks as and when the demand comes through to the Bank of Ghana. You are talking about intervention. We are still looking at the intervention issues. I guess you are referring to what the IMF did put in our report.
$4.3 billion.
We've had that discussion with the IMF, and we've come to the conclusion that there might have been some double counting in the numbers.
So it's less than that amount that has been put out by the IMF, or the amount is lower than what has been put out by the IMF?
The amount is lower.
I'm asking because they put out about $4.3 billion.
Is that what they indicated in that report?
I thought that is what I saw in the staff report.
I thought I also saw something like 1.4 billion in the first quarter. That report was talking about what we did in the first quarter, and they said we had intervened by as much as 1.4 billion. But if you dig through those numbers, you realize that a sizable portion of that amount is related to our gold operations, especially that with Gold Board. And if you look at Gold Board and what they do and how the Bank of Ghana comes in, you realize that not that full amount of 1.4 billion is intervention that we've picked from our reserves into the market. That intervention figure is gold that is already out there, that has circulated, has come back to the central bank, and the central bank then gives back that gold to the system. And the system again picks it up as intervention from the central bank.
Mm.
We've had that discussion with the fund. We've come to the realization that it was a miscalculation. And I think that at the appropriate time, all these numbers will come out well.
Doc, you are quite optimistic about the pressure on the cedi easing based on some of the things you have done. The governor in the MPC talked about the fact that you are actually meeting all the requests coming from the commercial banks.
Yeah, he did make that point that we meet all the requests from the commercial bank. And I think I said that it's related to the fact that some of these requests have come in earlier. They've been front loaded and we've been able to accommodate. Despite that accommodation, and you look at the numbers, you still realize that we have built reserves in the process.
The governor talked about certain measures that they've taken. One could talk about the remittance cleanup, that now we've seen that things are now improving in terms of inflows. Are you expecting that also to improve the performance of the Ghana cedi going forward?
Yeah, I mean, remittance inflows are always part of the equation. Remittance inflows are improving, so we expect that to support the economy as we move ahead. We don't have full complement of our Q3 BOP numbers, but by the time we get into the MPC in November, would have had full complement of Q3 numbers, and you will see that these remittances have sort of come back.
Does this action that you took and then the response
Which
again
action are you talking about?
the remittance cleanup that you
Yeah.
had to sanction some firms and all the rest, and the response that is coming in, strengthen your hand that maybe if the Bank of Ghana is just firm and very firm on a lot of these guidelines and market regulations, maybe half of our problems on the monetary side might have been solved. Just a little crackdown on remittance or review has seen the numbers pick up. You've done certain things again in the foreign currency space as well. We get from the government that things are also improving in that line. Do you get someone on the street who say that if Bank of Ghana can just enforce its rules to the letter, maybe a chunk of our problems when it comes to monetary and forex issues might be solved?
No, but John, you've just hit right on the nail. What all these things boil down to is that we need more intrusive supervision. Not just supervision, but we need to do it intrusively in the correct way and to ensure that the right things are done. I mean, if everybody were to play by the rules, I think these problems will all fizzle away. So yes, we need more of that in that space. We need to regulate and regulate hard, intrusively, to ensure that the right things are done and to ensure that they play by the rules.
I mean, you've done something on when it comes to liquidity as well. When it comes to the mining firms now auctioning their dollars to the commercial banks, you've taken a lot of measures that is actually going a long way to improve the liquidity in the commercial banking space.
We are giving back. We are giving back to.
Are you that optimistic that this and all these other measures, remittance as well, could again deal with the current pressure on the cedi that, listen, going forward, things might be okay?
There's a whole gamut of activities, macro soundness, intrusive supervision, and then ensuring that everybody plays by the rule. All these things work together to deliver a certain goal, and this is precisely what you're talking about.
Let's come to the bit about some of these recent enforcement thing, and there are some who thought that you were too harsh. I mean, these are the rules. Pricing in FX should stop. The over-counter withdrawal for people who have not put in any money in those accounts. The foreign exchange account, the 5%. There are some who feel that Bank of Ghana is trying to, in another breath, is trying to kill a fly with a sledgehammer. What do you say to those people who are worried that we are a free market, so let's have everything free? If the structures are in place, we shouldn't see that as a problem.
Well, but I don't think there's any free market anywhere
Mm.
in the world. So it's
I mean, a
about
real free market, actually.
yeah. But George, I believe that we always need some regulation because if you leave the child free to do whatever he wants to do, he might go wayward. So we always need something to check the way things are done. Free markets, the textbooks will tell you that, look, even in those developed countries where they talk about free market, you don't get it 100% free market. There's always some regulation to ensure people don't move above the limits.
The governor described the current challenge with the city as seasonal, as a blip. The correction is taking place. Do you think that the worst for the city is over in terms of we've seen the worst already, and going forward, things are actually going to normalize?
Well, I think things are normalizing, George. The economy has normalized. We are still in a recovery mode. Things are getting better. I think all these things boil down to one thing, which is expectations. That's how I see these things. So let's do the right thing. Let's get our fiscal house in order, which is on the right track. Let's get monetary policy to do the right thing. Let these two authorities work together to deliver both inflation and growth. And I think we should be fine.
Doc, when we come up, you look at the banking sector. I mean, how are you expecting the commercial banks to respond to your policy rate cut, the transition mechanism? Some are saying that sometimes it takes a long while for Kobna Mensah or Ajoma Mensah in Mantimankebi. Why should she be excited about this action that the Bank of Ghana has taken? Market confidence as well, all these issues. This is PM Express Business Edition, engaging the Director of Research at the Bank of Ghana, Dr. Philip Abrodutu, as we try to get some understanding of the monetary policy process. What would this mean for inflation? What would this mean for the city? And what would this mean for the larger economy? We'll be right back after this break. Welcome back to PM Express Business Edition. As you look at the recent cut in the policy rate, what that would mean to you if you're servicing a loan or you intend to take one, and how would that impact on the current pressure on the Ghana city, the economy, and even inflation as well. Engaging the Director of Research at the Bank of Ghana, Dr. Philip Abrodotu, who is my guest on PM Express Business Edition. Doc, there's always been a question about transition mechanism. There were a lot of businesses.
Transmission?
Mechanism.
Okay.
People have complained in the past that bring the policy rate down, bring it down so that cost of credit can be felt. From the bank's own extrapolations, the modeling that you put together, the research department, when should we see these commercial banks respond? Is it that their next monthly rate adjustment, the Ghana reference rates, and all those things? When should that market woman in Mantimankebi, who walks into a savings and loans to take a loan, feel the impact of what you've done right now?
Now, if you look through the data pack that was published prior to the MPC press conference, you realize that following that 300 basis point adjustment that was done, all the other rates have aligned. So you see that the lending rates, the average lending rates, they've gone down by 260 percentage points. And the process is still is still working its way through the system. So lending rates have responded. We've done another 350. I was encouraged to see the lending rates go down following that 300 basis points, and we expect more. A 350 has been done. I expect another 350 to be done to lower the cost of credit for businesses. That in itself is a transmission. The way I think about the transmission from the central bank to the real economy, it happens in two stages. The first stage is from the central bank to the commercial banks. And then the second stage of the transmission is from the commercial banks to the real economy. Normally, the transmission from the central bank to the commercial banks is full. It's always 100%. Then in the second stage, at times it gets a little bit quirky. It gets a little bit tough because of probably the conditions of the commercial banks, and they try to risk profile their clients, and in the end, the rates don't pass through well to the rest of the economy. I've seen this first cut that we did pass through already to the rest of the economy, and I think as we go down, as the banks continue to operate profitably, as the banks continue to operate in a well-capitalized environment, they'll begin to pass on some of these to the rest of the economy.
The 300 resulted in some 250 basis point cut in the banks, the commercial banks responding to businesses, right?
Yes, I saw.
Are you going
260.
to see about some 300 this time round again?
We should. I think we should.
And all other things being equal,
we
should the impact be felt in somewhere in October, maybe November?
Yeah.
I'm looking at that person again, maybe Anomabo, who is watching us right now, and say that I want to walk to that rural bank to take credit. Should she wait till middle, if it's a viable rate, middle of maybe October, ending October, maybe first week in November, to feel this impact of about a 300 basis point cut?
No, it should. I think by the next time the next round of data comes through, we should see that impact already out there.
So somewhere in early November, or maybe?
Yeah. We should.
Do you think that the commercial banks will really pass on this to businesses and consumers? There have been always arguments sometimes that when this thing is passed on to the commercial banks, we don't feel that much impact when it comes to lending.
Do you realize that suddenly they are beginning to advertise for people to come in for loans?
I've not seen that one.
Oh, okay. So it's happening. And I think we are slowly getting to a point where the banks will now begin to fight for customers. Yeah, I think so. They'll begin to advertise for people to come for loans, because the real money for the banks is going to come from how much you can lend. How profitable a bank will be as we move and go through this adjustment phase, it's going to depend on how you can get customers on board and lend and make money from them. So lending is going to take center stage, and I think this is where we are headed.
Do you think that the environment would also help these businesses to repay on time? Because there's also a question about the NPLs, which was also captured in your data that you released. That is a bigger concern there, whilst we push for cost of credit to be reduced as well. What is the current condition these businesses are working in that they will be able to?
Well, I think the data that we published, we saw the NPLs around 21-22%.
That is still high.
That is still high.
Very, very high.
That is still high. But if you go behind the numbers, again, you see that these NPLs they are concentrated with a few people, with a few firms. The question is, are the banks profitable enough to absorb these NPLs and then bring the NPLs back to normal? I think yes. If you adjust the NPLs for these few individuals and few firms, some of the issues are legacy issues that have crept into the NPLs. I think when we clean up all these things, we should have much lower NPLs. The NPLs are high because of a lot of these legacy issues and some of the people behind these facilities that have stayed on the books of the banks for quite a considerable length of time.
The flip side to this NPL thing is about it impacts on the cost of credit. So whilst you are trying to reduce policy rate for it to have some impact on the cost of credit, you have this elephant in the room, NPLs, which could also erase all this good thing you're doing.
Yes, so that's why the NPLs are being restructured as we speak, and that is exactly what I'm talking about. There's a process of cleaning up the NPLs with the banking supervision is working on currently. They'll be taken off the books of the banks, and it should allow them to then begin to price credit appropriately.
I've looked through your books. They're quite very tough measures, even blacklisting, recalcitrant borrowers and all the rest. I mean, the rules are quite tough. I mean, for the commercial banks even.
Is it bad? Is it bad?
It's not bad, but again, the free market argument comes in as well. You know, is these rules in trying to correct these NPOs not too tough and harsh?
No, they are fine. I mean, central banks all over the world need to be very tough. They need to move the hammer where they need to ensure sanity. I think it's in the right direction.
How would you, again, I go back to your data, how would do you think the banking sector is quite robust? Do you think is quite tough? Is it quite doing resilient to shocks and all those things going forward based on what you captured in your MPC data?
Well, so there's an aspect of the banking sector analysis that we do that looks at the soundness of the banking sector through stress testing. So we stress test the banks for a variety of indicators, a variety of shocks. And when you do that, they withstand these shocks all the time. You know, the banks here are the most profitable in the sub-region and elsewhere.
High interest rates, of course, very high interest rates, and that plays a factor.
So they are strong. Our stress tests do show that they can withstand shocks, and I think they are in that position. As interest rates decline, as inflation behaves, for me that is the key indicator. As inflation behaves and as it drops, interest rates everywhere will begin to come down, and the banks will now need to rethink their business models and engage more in lending activities to support the operations.
You are under an IMF program. I mean, if I read the monetary policy side of their statements they put together, the fund is quite excited about a lot of things that you've done. How does the bank take some of these terms up, even recently with your Forex actions, even with how you've gone about the inflation targeting and all the rest?
But did you read the press conference that was put out, I think, last week?
By Julie Kozak, when she talked about the Forex issue?
Kozak, I mean, yes.
What does it tell the team here, the committee, the governors, when you look at some of the things that the fund has said about the monetary path?
Well, look, it emboldens us. It's always good to get the feeling you are being watched from outside and you're being told that you're on the right path. So it emboldens us. It tells us that we're on the right path. It tells us that we should continue doing what we are doing currently to deliver on our key objectives. So yes, it's good. We are emboldened and we are happy about that.
How do you expect investors to also respond? I mean, with these policy rate cuts, the offshore investors and all that. I mean, now we are not that heavy on the international market, but there is still some secondary round of interaction when it comes to these offshore investors. I mean, when I saw the real interest with it being high, some are saying that that is good for these offshore investors. You're closing the gap. Should that be a concern for an offshore investor if I am one?
Well, but you know that ever since we got off the international bond market, our interaction with these investors, have gone down, and they are not heavily present in our market these days. So there's no issue about these investors taking advantage of the high interest rates here to move in resources. Lately, we've had investors come in, and you know what their interests are. They're a little bit excited that interest rates are going down. They're excited that the macro is coalescing well. So they are thinking about the kinds of investments, hard investments that can be brought into the economy, not hot money. That interest rate is associated with hot money, which moves out hotly as it came. But this time they are thinking about coming in with hard investments through GIPC, working with Ghanaians. So we've had some investors come in lately. We've also had the opportunities to ask them how they feel about us. And their response is consistent with the thumbs up we got from the IMF in their recent communication interview that they had with other journalists.
I mean, Doc, as we try and wrap up on this interview, there's a concern about the monetary side as well, post IMF program next year after May. Together with the team here, Monetary Policy Committee, governors, and all the directors, especially those at the research department, what assurance do you have for the market about that monetary discipline that post IMF program, when it ends in May 2026, there's a strong fear out there about how things will look like when we exit this program?
Well, I think things will continue as they are. Monetary policy will still continue on this path. We've always done this. We've never shifted. Fiscal policy will also continue to do what it's doing currently. There's a fiscal responsibility law that is coming on board. And I think when we have the monetary and the fiscal well situated, I think the two should work together to deliver our goals.
You talked about the fiscal sector. What is the relationship like between the fiscal and the monetary? There have been always concerns about sometimes fiscal dominance. How's the situation right now in terms of that relationship between the monetary side? I mean, I remember one time Dr. Dufour explained to us there were times when he has to bounce check coming from the Ministry of Finance as well. What is the relationship when we talk about the monetary and the fiscal side, as well as assessing your independence?
Well, I haven't seen checks being bounced in a very long time.
Okay, because there's no financing, rather zero financing. Is that being enforced as we speak right now to the letter?
Well, so ever since we started the IMF program, it's been a key indicator that is monitored all the time, and that is being enforced to the latter. So since we started the program, it's been zero financing all throughout, and that is being forced. The thing about fiscal and monetary policy is that, see, these two institutions need to talk together so that their policies are well coordinated to deliver the goals on both sides. That is being done. And there's a vehicle that allows us to meet and discuss policies and then look at the consistency in policies. And this is the EPCC. The EPCC is the Economic Policy Coordinating Committee. And this is a committee of the central bank and the Ministry of Finance. They meet 4 times in a year, once every quarter, to look at policy issues. Last week, we just had one with the Ministry of Finance. And we looked at all sorts of things on the fiscal side. They also look at all sorts of things on the monetary side. Then we try to ensure that both of us are consistent.
I like the consistency and then the assurance you give me, but some market watchers will look at T-bills rate when it was around 10% and OMO rates being around the 20%, I stand to be corrected, as a typical example about whether the fiscal and the monetary side working together.
Convergence is coming. The two will converge.
It has taken quite a long while, some would say. And that raises questions about whether the fiscal and the monetary side are working together.
Well, but George, it has taken a very long time for inflation to get to where it is now. We hit inflation almost close to 60. Then we came to 23, and we stuck at 23 for 2 years. And now we are now tail spinning back into single digit modes. 2 years, inflation at 23, it's a very serious matter. Okay, so then the question is, both the T-bill rates and the monetary policy rates, there need to be some convergence.
It has taken quite a long time, though.
It's coming. It's on its way.
It's taking quite a long time, and that's what people are worried about, whether
it's coming.
These two strong institutions are working together.
We are working together, and I don't see any friction.
I mean, again, going forward, some will say that, so what assurance do you have for the market? I mean, when we look at all these things, and there is still some anxiety. I mean, Dr. Johnson Ishima mentioned anxiety. He doesn't understand. There are some who still look at these numbers, look at the cedi, and they are still not convinced that we are getting out of the woods.
I think what the governor...
From the monetary side, what assurance do you have for the market, for the businesses out there, to try and deal with this anxiety thing that has fed into the cedi? And those who are saying they're still closing, they are asleep, but they still have one eye up seeing what is going to happen on the monetary side.
On the monetary side, we'll continue to work to deliver on our objective, which is inflation. I think that is the key thing. When inflation is cool, all these other indicators will fall in place. So we'll continue to monitor the space. We'll continue to talk to Ministry of Finance. We'll continue to tread on our coordinating mechanisms that we have in place to ensure consistency in policies. And we'll continue to ensure that we build enough reserves to help us deal with volatilities in the exchange rate as and when they occur. I think there's a lot of fixation on the exchange rate. It is one of those prices that we have in the economy, just like any other price. It could go up, it could come down. I like it when it goes up personally, and I like it when it comes down, because you know what? When it happens that way, and agents understand that anytime it goes up, it can come down, and anytime it comes down, it can go up, these agents don't tend to look too much at the exchange rate in pricing their goods and services. So it informs their pricing behavior. The exchange rate then becomes not a key element in their pricing behavior. The ups and downs, to be honest with you, George, personally, I think they are good.
So those business...
I mean, George, look at what happened to the appreciation. We had an appreciation, and some segments of the economy were not too happy with what had happened. It's had an impact on fiscal revenues in one breath. In the other breath, importers think it's fine, it's cheap for them to bring in the goods. So we need that exchange rate that will satisfy both sides of the economy. And in that way, we can have that equilibrium real rate of interest that will satisfy every facet of economic life.
So for those businessmen
Yeah.
out there, the assurance is that the worst is over.
Well, for those business, the assurance is that we are doing whatever we can to ensure that there's stability on the macro front. That's what I
Dr.
have to
Philip
say.
Abrodoto, I appreciate your time so much. I'll come back again if there's any pressure on the local currency or there's some challenges out there in terms of coming back to you to say that, what happened. And I know you voted on the committee. What did you vote for?
Well, I did indicate at the beginning that it was unanimous. It was unanimous in the sense that all the committee members thought that we needed a reduction in the policy rate. There were differences in the magnitude. So I was biased towards bringing the interest rates down, but I won't tell you how I voted.
I mean, the report will come out, so we'll know the members, and not by name, but how the members voted in that document, right?
Oh yes, you see, you see
but I'll
the
be looking out
variations.
for Doctor. Based on what you told me now, I'll be looking out for your notes in that report, Doc.
Thank you very much, George.
But Doc, I mean, again, the Federal Reserve rate has dropped as well
by 0.25 ahead.
There are some who think that people could be moving to, some of these offshore investors could be moving to our market, and even for gold as well. And the record performance of gold, some are saying, is quite interesting.
Yeah. I mean, there are those who are even saying that the latest reduction in the Fed rate bodes well for
economies like Ghana.
And there are those who are saying that, well, the dollar will continue to weaken. Yes. And therefore, what happens when the dollar weakens? There is some realignment that goes on in other currencies. Will the cedi gain? These are all the issues.
There was something I tried to, and as we try and wrap up on this interview, Doc, apart from the gold hedging program as well, what other initiatives is the Bank of Ghana undertaking to ensure that the good returns that we are seeing? Because you remember the governor said that some of these strong external reserve positions that we've had has come from cocoa prices and gold. What are we doing with the hedging of the gold and other programs so that when there is any global shocks, at least we can manage those shocks?
George, I think apart from the hedging,
which should happen very soon. I mean, you're almost through with the model and everything.
Yes, we also do invest our reserves elsewhere, in other instruments elsewhere in the world, and all these things come in to give us some additional reserve buffers. And then the question again is, then do you also want to limit the way you intervene on the market to preserve the little that you have for a rainy day? Is that how they say it? For a rainy day? Yes. So there are so many ways of going around this.
Doc, I appreciate your time so much, and I'll definitely come back again for a second round effect interview on all these policy measures that you put in place. This has been PM Express Business Edition, engaging the Director of Research at the Bank of Ghana as you look at the recent cut in the policy rate, its impact on inflation, the Ghana cedi, and even the larger economy. I know the debate will still go on in your homes and your offices about whether the Bank of Ghana could have done more, maybe 500 basis point cut in the policy rate, or maybe 600. This has been PM Express Business Edition. Have a great day.